to conversations with people I've done spaces with before and make it more visual because I like to see people's faces. So I'm glad to finally see Ashraf in this kind of format. We talked a while ago, Ashraf, a lot's happened to the marketplace. I know you're focused on intermarket analysis and currencies and metals and yields. Just before we went live, you were talking about the Bank of Japan. Now, I happen to have been writing about the Nikkei's movement, saying that no matter what the stock market does there, I don't think that's enough to save and beyond just the FOMO of the moment. But lay out just what's going on with Japan in terms of their own stock market, their currency, and some follow.
Yeah, very good. Michael, first of all, congratulations what you're doing. You are producing these chats like a powerhouse, and all power to you. And the idea of an impromptu is good. We've got a lot to talk about. This is a pivotal date, not only because it's the last day of the month, last day of the quarter, and where is that rebalancing that people talked about? Is it going to happen? But it's more than that. Right. So this is a very busy chart. So I'm going to try to simplify it, and I'll explain what it is. And why does it matter for guys who are relying on bond yields to finally go down, or those who are worried about bond yields breaking out, those who are a long gold position at, 2000, and they're worried that it's going to go to, 1870. So I'm going to look at this, and this is basically why does the Bank of Japan matter? And it's just, people say, well, we know why it matters because the Bank of Japan is the only central bank that is easing, that is in some sort of a quasi, that is doing wild yield curve control, that it basically includes QE. And if they stop it, or they will leave it, or gradually phase it out, like hinting at, which might take a month, then people are saying that the JGB yields, Japanese bond yields, are going to rally. And for those who have been, in the market less than 10 years or 15 years, short-term interest rates by the Bank of Japan have been below 1% since, I believe, 1997. And when I finished my class in central banking and currencies and central banking, when I was doing my master's, it was a class that I took in end of 1994. And the teacher was telling us how the Bank of Japan interest rates are about to fall below 1%. And we all know that they were the first one to start QE, and they started QE, I believe, in 2003 or 4. But ever since then, and they have a problem with this inflation and so on and so forth. Now, so people are saying that, yes, the stock market is at a 33-year high in Japan, and inflation is finally getting back up. And this is the time for them to gradually stop the practice of YC, which is removing the cap on bond yields. And people are saying that if they do that, then bond yields are going to soar and so on and so forth. And as long as they continue to do the YC, because it's the only, guy in the block that is doing easy, obviously the Japanese yen is falling. That means all the currencies are pushing up against the yen, which was the trade to do last year. So my job is, what do? I have clients that I'm trading for me, and I have, a WhatsApp service with people who are going in all sort of leveraged yen positions. There are, some people have been shorting dollar yen at 138, 134, and they're down like 6 pips. And then what the hell do we do? And Ashraf, you're moving the goalposts. And it is about, are we moving the goalposts? It has been a crazy time of moving the goalposts, whether people have been telling you the 10-year yield is going to stop at 355. And now they said, oh yeah, it's 377 is the big one. And oh, it's 385 is the ultimate one. And then I moved the goalposts and I said, no, don't look at bond yields. Look at the bond price. Look at the bond price. Or look at the yield on the 10-year German bond yield, which has not broken out. Then I'll change the goalposts and I tell you, no. Look at the 30-year. And I know very well there's some people, very smart people who are listening. They said, Ashraf, you're getting your yields mixed up. The 2-year yield is about what we think is going to happen in the next, the short-term interest rate, what the Fed is going to do, while the 10-year is about the economy and so on. Yes, we know. So I'm going to get to a comprehensive yield chart in a bit. But before, let me just do that. So for those of you who play FX, this is going to make sense to you. And so let's start with this. So this is the Japanese yen. This is the trade weighted index, okay, by the Bank of Japan. It's the yen just against the dollar. It's not the yen against the Australian. It's the yen. It's more or less like the DXY or the Federal Reserve Dollar Index. And I'm going to try to explain this here. So look at this. So again, so basically when this thing goes down, the yen is going down against a basket of currencies. So just to give you an idea, the intervention started last year, right? So for those of you just to get an appreciation. So summer 2022, the Federal Reserve was raising rates gangbusters, 75 basis point became the new black, and the gold was tanking, the dollar was rallying, and NASDAQ and everything was on the chin, and NVIDIA was even, and no AI, it was IA. It was far before that fateful, famous November when everything you touch went up. So this was the summer. It was a very hard, long, hard summer. And gold was tanking and the dollar was rallying and the yen, which has a very high correlation with gold, is falling. Now, and then it becomes, obviously the dollar yen was nearing the key level, which is 147, first time since summer 1998, and so on and so forth. So all of this background noise is for you guys to appreciate. For us is, what do? Do we just sit here and say, so let's just go to this because there's something very interesting. And listen, guys, I'm going to make things easier for you because when I speak about things, I tend to be detail oriented, but I'm going to give you the summary of what I'm going to say before I say it all. Okay. Because many of you have a lot of better things to do on a Friday afternoon or Friday evening or Friday morning. So I'll give you the summary and then I'll tell you why I'm thinking that. Basically, I think number one, the Bank of Japan will have to intervene. Okay. They will have to intervene. Whether they're going to intervene at 150 or 148 dollar yen or 149. And I will tell you why you who are trading bonds and you who is holding NVIDIA and those of you who care about bonds, why you need to listen to this. And I think they will need to intervene, but no, not right now. They will start with verbal intervention because there are two big events. The first event that matters to them before I talk about the Federal Reserve decision, which is July 26, 14 days before that, meaning 2 Wednesdays before that, we've got the CPI. And the CPI is July the 12th. The Bank of Japan, like I tweeted yesterday, they are the masters in looking at the weather and surveying the weather conditions before they go in, before they risk being a deer in a headlight. They don't want to buy the yen and sell the dollar 2 days before the Federal Reserve is going to go back to raising rates. So here's what's going to happen. I think they're going to do verbal intervention probably next week. And again, I know there is something in Japan that usually comes out on July the 4th holiday, and it's called the Tankan survey. It's one of the biggest comprehensive surveys, the quarterly surveys from Japan. And it comes in around when the US is asleep. And that tends to move the yen and the market. So they're going to look at that. They're probably going to verbally intervene. And then we're going to get close to the following. So not this coming week. So not next week, the following week. That's when I think there's going to be some sort of chances of a real intervention around the CPI of July the 12th. If July 12th CPI is going to be relatively weak and neutral because today core PCE, well, it had a little bit of everything for everyone. The year on year came in down a little bit. So that's what helped gold today and what helped dollar yen down. But they could probably intervene. But for those of you who remember what happened, so here is the chart. The first vertical, so there are two white vertical lines. The first vertical line, it was on June 10th when they verbally intervened. Okay. So, and why? Because the yen was falling. And the second line, VI, is also verbal intervention. That's when they intervened. So basically, do you see this, Michael? They intervened and the yen went up, but it was verbally. Then it came down, blah, 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 June, July, August, the yen went up. And then they intervened again, it went up. And then we have this light fuchsia or green or light blue line here, which is a CPI. And that CPI of September 13th came in stronger than expected. So these guys are smart. They were not going to go and spend money and have a real intervention before the CPI was going to come. They knew the CPI is coming September 13th. Like I am telling you, they know that next CPI is coming in on July the 12th. So they're not going to commit. So this is what happened. So the yen went down, it went back up, blah, blah, blah. So, and here is what we had. So this blue line is the first real intervention. Okay. And it happened on September 22nd. Does that ring a bell to you, Michael Gayet? September 22nd is one day after September 21st, which is the Federal Reserve decision. The Federal Reserve raised rates by 75 basis points on September 21st. Dollar yen went up, bond yield went up. Now I'm going to show you the other charts. Now that you've gotten your eyes used to this chart and these lines, I'm going to add other markets. So here is what's happening. So this is when they had the real intervention. Sorry, in the dark blue. This is, the yellow is gold. The green is dollar yen. And the red is 10-year yield. Okay. Again, look guys. So let's start with the yield. So the Fed raised by 75. Dollar yen went up. Yields went up. They intervened. It was a testing the water intervention. Testing the water. But but the yield went up, and here's a dollar yen. So again, the blue line is the first real intervention. Then later on, we had the second of what? Of October, and there was the second CPI. And you see these two? These are the second and third interventions. And these interventions happen, and now just for you to appreciate this, dollar yen. So then was October. I was in Dubai. I remember very well. And the second one was October the 20. It was a Friday. It was October 21st. It was a sleepy Friday. It was 4:30 p.m. London time, -5. So it was 11:30 a.m. New York time on a Friday when they intervened. And look, guys, what the market did. The market was already falling. It was already falling, and it never looked up. Why is this a game changer? Why this could be a game changer for you guys who are, wanting to put in the yield in the discount model, or wanting to know where the 10-year yield and so on and so forth, or guys who are trading gold. Why does this matter? Because look, now that you've appreciated the dollar yen went up and then it came down and it had a false decline and then it wasn't put to bed only after the third intervention, which is here. Look what gold did and look what yields did and look what dollar yen and yield. Yeah, I mean, I had an S&P there, but so this is the traded weighted index of the Japanese yen. As you can see, after the second blue vertical line, the yen went up and he said no mas. So let's forget about this. But what about gold? What about gold? And this is something that I do called intermarket metal analysis. So one of the reasons, so gold was in the middle of a bottoming process. Rings a bell? It could be now. It could be now. Was in a bottoming process, but guess what? Silver had already bottomed before. Copper had already bottomed before. Platinum had already bottomed before. And gold is the last of them all because he's the last one to get the memo because he's the one that is more volatile. He is more attuned to speculative attacks and so on. But look at this. Again, after the last intervention, gold reached a bottom. It did try to go down, but it was a higher low. And look at dollar yen. We saw this. But look at the 10 years where you guys, non-Forex guys, come in. And the yield. So again, you see this line? There are two blue lines. The second on the right is the big intervention. And some people are saying, why on earth would the 10-year yield on the bond of the US government go down when the Bank of Japan intervenes? Some people are saying, is it supposed to be the other way around? Because, it's the carry trade, but that's the way it works. And guess what? And this, my friends, it is no surprise. Call it coincidence, call it whatever you call it. But the last big intervention, the Bank of Japan, with the high yield. So whether you're a fixed income manager, whether you're trading bonds on Robinhood whether you are trading, I don't know what options on fixed income, or you are putting all your grandmother's money on the TLT, you need to understand this. I will give you chances to ask, because if you don't ask, you will never speak again.
You will tell us. I know. No, but I'm in agreement, by the way, with everything you said, and we're coming up on the top of the hour, but I will say that I think that the thesis is very interesting. I hadn't looked at the BOJ, but that does line up with other intermarket dynamics. And myself, I'm seeing that gold could break out, finally start that FOMO move. Volatility kicks in. The treasury side may have topped in yield despite ongoing surge of inflation. I keep saying they're going to keep on inverting the ever-living shit out of the bond market. So a lot of interesting dynamics. Ashraf, for those that are listening to this or watching us, aside from Twitter, where do they go to find more of your work?
Yeah, it's ashraflaidi.com. I mean, if I were to give you, I'll be done by the way or what?
No, we're still streaming.
I mean, we've got a service. It's WhatsApp, a broadcasting service, both who are trading and who want to get like notes and messages and trades. And we always send the voice back in English after the Federal Reserve, after the core PCE, after the MI, and be careful of the accounts and everything. But if this is Laidi, this is my Twitter, this is my website. Ashraf Laidi, got archives going all the way to 2000, and appreciate that. Look at this. So this is the bond universe. So basically what you need to see is that, so this is futures of the bonds price. And you're only worried if basically already broken. Okay, this is inverted the head and shoulder, and we're not. And this is the same thing with the RA2. So this is the bond futures for the bonds, and you can see the inverted head and shoulder, the right shoulder is well supported, so it's still relatively not bearish. And the equivalent of the US bond futures is also respecting the green, the right shoulder. And then you can see the blue is the 30-year yield in the US. And you can say that the Danish thing, which is 4%, and we're not breaking it. Okay. And then you have the 10-year yield, which today, just when everybody thought they were going to break out, it came back down below 3.85. So you need to look at, it's not moving the goalposts. It's also looking at this. So this is the German 10-year yield. Does this look like to you that has broken? Does it look that? No, it doesn't look like. A right shoulder, has it broken? No. So the formation is still intact. All right. Now, and so going back to the BOJ, and this is the 10-year yield in a way. So you can say it broke, it didn't break. So basically the master plan here, and I didn't even talk about gold because we have to wrap up and so on and so forth. But the plan is that do not rush into making rash decisions and conclusions about the Bank of Japan until we get close to the CPI, which is July 12. From here, then on, I think we could go easily towards 146, 147, but the Bank of Japan, they could surprise you easily. And once they do that, it will be a very good example for gold to come in and to reach that bottom. This is the Australian dollar. It is respecting this horizontal level here. And I would like to wrap this up. I'm sure you brought a lot of gold bucks, and I'm sure you brought a lot of gold experts, but there is, I bet, what I'm going to end with that somebody has never said this, which is what? Let me go to the JPEG, a chart that I showed that I did actually yesterday, end with this. And this is about gold performance. Very interesting. So it is important. It is actually starting to be an edge. Yeah, this is, okay. This is too small. Basically, here is what we're saying. Guys, we're saying that gold, each time it ended the second quarter lower, but still higher than the open of the year. Okay. It would end up to go higher for the rest of the year. Okay. So this year, the second quarter is lower than the end of the first quarter, but we're still up on the year. And each time gold did that, it went up. It may have a difficult third quarter, but it continued to push. So,
and I want to leave on that clip here because I have to agree with you, and I want to do this again hopefully in the next few weeks. Want to see what DOJ does. So everybody, please make sure you follow Ashraf. Again, I'm trying to do these impromptu conversations live only, so it's got all kinds of interesting dynamics when it's live. But appreciate those that are joining, and this will be replay, as you can see, on my Twitter account as well as YouTube and everything else. Thank you, Ashraf.